The global meltdown in 2008 was triggered largely by irresponsible lending. It had a much larger impact in the US on real estate, whereas Canada appeared to be minimally impacted. Have we learned from that experience, and what do you think would be the likely cause or trigger of the next economic event? So, Andrew, let me start with you. How was Grosvenor impacted in 2008, and what do you think the next event might look like?
Well, we didn't know. We were like everyone else. We were scared to death. I was told immediately by my parent in the UK to get into cash. I mean, to get, so 10% into cash. And what we found out very quickly was we were at that time, 60% of our assets in the US, 40% in Canada. And we found out very quickly that we were not liquid in the US, but we were in Canada, because of the banking system, because the market here is quite liquid. If you want to understand Canadian real estate, it's the guys Don works for. It's Canadian pension funds. They love real estate. They love yield, and they like, and the real estate they buy they prefer is, high quality investable real estate. Anyway, so we, it was one of those things where, Grosvenor sells, one of the things we're going to sell is the Grosvenor building. So, whoa, Grosvenor's in trouble. Why would they do that? Now, the truth was we had it slated for sale for about 5 years, and every year cap rates went down and income went up, and so we didn't sell it. Anyway, and the idea was we did it, first of all, for safety, secondly, for opportunity. And the opportunity bit has worked out, because once the green light went back on to start investing, most of what we did has been development. We have 14 projects going, $2.5 billion pipeline. And I just wanted to add to that, it's not just yield with development. One of the best things about doing development is just a mentality that you're going to do something. You're not just going to be a passive investor. You're going to improve it. So obviously development starting from ground up or brownfield or whatever, you do it. But I tell you, with staff, it goes right the way through the company. If you own a building, you think, how can I change that? How can I improve it?
It's a great plug for our value add fund, isn't it?
Yeah.
Don, can you explain what GWL experienced in 2008 and how you learned from this? And how does it help you prepare for the future?
Yeah, so this may sound like a shameless plug for real estate as an investment asset class, but in 2008 and going into 2009, the income that was produced from our portfolio was completely stable. On the margin, we had some tenant failures as a result of what happened in 2008, but it was not consequential. Capital values came off about 6%, which basically meant that the total return for 2008 in our real estate portfolio was zero, against the TSX coming off 35%. And then the recovery in 2009, 10, 11, and 12 was pretty attractive in terms of total return. So that's a takeaway for people leaving tonight, I think. And it's just the importance of real estate having a place in your investment portfolio. Yeah, exactly right. Now, look, there was lots of other consequences. Debt became very expensive. And, we're fortunate in that we had the luxury of being able to pay down debt with equity rather than refinance. Not everybody's in that position. If you own real estate personally, a lesson learned is don't fall in love with your real estate, because someday there may be a liquidity event, and you better be prepared for that moment in time. Make sure that you've logically staggered your lease expiry profiles and your debt maturities, so you're not kind of caught out at a moment in time.
Thank you, Don. John, you get the last word. Can you tell the audience what happened at Venterra? Did people pay their rent in 2008?
Yeah.
And what did you learn from this event?
Learned a lot. Luckily, I had a fortuitous meeting when I first got into the business about 15 years ago. And it was with a person who had invested in multifamily properties in the southern states, actually, for a couple of decades at the time. And I said, what's the single most important piece of advice you can give me? And he said, John, no matter what, always have the ability to hold on to your assets, because as dark as it may get, the values will come back. And trust me, I replayed that in my mind many times. As Andrew said, it was a very scary time during the financial crisis in the States. Canada was a relative sea of stability during the financial crisis, as Don mentioned. But it was scary. And commercial real estate values went down by 40%. Apartments didn't go down by that much. But one of the things that when I heard that guy say that to me 15 years ago, I said, we're just going to take whatever everyone else is using in terms of leverage, and we're going to use less. So we used less, and it was a blessing. Because the rents were still cash flowing, et cetera, but you needed to watch out on refinances. So the second thing that that we did that was good, it's not only important to have low leverage, but also important to have cash, because properties were coming due, their loans were coming due, I should say, in, say, early 2010, and the capital markets were not functioning well at that time. And we had enough capital to put it in and get a refied loan. And every one of those properties did well. I mean, quite frankly, because we were able to hold, the properties did way better than we even thought they were going to do. So low leverage, whatever else is using, just use a lot less. Have a lot of cash on the side. That's what I've learned. And in terms of where I think one of the questions is, where do you think the next bubble is going to happen? We're going to have another bubble. I don't think it's going to be in the States, but the whole thing that caused the financial crisis, in 2007 and 8 was too much debt. And the non-financial debt relative to GDP was 220% around the world in 2007, 2008. It's now 225%. So we haven't delevered. We just moved the debt around. I think it's poor transparency. I think, China's an issue. I think Europe's a big issue. I think developing countries that have large amounts of U.S.-denominated debt with the U.S. dollar going up is an issue. But just literally 30 seconds on each of China and Europe. China's got poor transparency in terms of its economy. I don't think that's the real issue. I think it's Chinese demographics that is the real issue. By 2050, China's, and this is predictable, is going to have 186 single adult males for every 100 single adult females. There's all kinds of economic, social, political consequences of that. By 2050, China's population is going to be declining by 4 million people per year. I think China's, every year that goes by, this is not consistent with the rhetoric you heard in the election cycle or what you hear in the press. But I think every year that goes by, China becomes less of an economic threat, but there'll still be a threat. There's 1.5 billion people, or whatever the number is, with demographics that don't support a stable society. So that's a big issue. You don't know when that can sort of come out as a black swan event. Europe has the potential for really serious social and economic turmoil. There's going to be, I don't know what the percentage, but it's a high chance of millions more of Syrian immigrants coming into Europe, where you have a number of countries with youth unemployment in excess of 20%. That's a purely combustible situation. You've got fiscal austerity, you've got strained trade relationships with the US, you've got threats to NATO funding, you've got Italy's referendum coming up in December, you've got an incredibly fragile banking system relative to North America. All of that means that Europe's got heartburn, and it's getting worse. If I had to guess, I think it's the most likely location for another Lehman-style event to emerge. It's not going to. I don't think the threat is the U.S. I don't think the threat is Canada. I think it's China. It's Europe.